So we're going to talk about um, the banks, actually discovering where the banks are in the market, and where we like to get in positions once we see what the market is doing and we know exactly what the banks do. They consolidate the market, then they shoot it down to shoot back up in a different direction to hurt retail sellers. So for instance, I'm marking up this chart right now. This is British Pound JPY, um, and is on a bullish run right now. more EJ of a bullish run, but locating targets where the market is heading. So where is price at now and where is it headed? So if we're just looking at, where is price at now, we can see that it's in between, well, it's on the upwards momentum, right? Clearly that's an upward shift, right? And we just looking at, if we understanding ranges, and we understand that, hold on, let me take this magnet off. If we understand the range, it just broke the range that it was in right there, right? So that means it's a shift of structure. It created a higher high, right? Because this is, if this, you're looking at the structure right here, right? This is considered higher high than these. So now the market is pushing upwards. If that makes sense. Because if it would have made a lower low down here and just made a higher low and made a lower low down here, then it still was on a downward shift. But since it broke structure, you can see that it's on the upwards momentum, right? So if we just want to just, where is the market heading, discover where the market is heading, you're looking at your next places that the market could go, which I have above these highs, right? Because that's the range. That's the high of the range. And those are equal highs at the top. But then you got an imbalance. You have the institutional candle, you have the imbalance right below it. And why is that the institutional candle? Because that's the last up candle before the huge down movement. So we know the banks could be behind that candle. So that would be my target to ride this up to.
Is that high that you got marked over there?
The highs, the two equal highs are basically sitting money. This is where money is sitting that the banks have yet to come. So if we understand that the market just took a lot of money on the downside, so we're just putting, just marking up where the money was taken right here. That's a lot of money that's been sitting in the market for a couple, since November 23rd. So just took that money. So where's the next money? Next money sitting is at the top. So we see the break of structure going up now. We can expect the retest for the higher low. Like you see, this is a lower. It's a lower, where this is a higher high. This is a lower high. This is a higher high. A higher low. This is a higher high. So then it made a higher low. Then it made a higher high. And it broke structure. So now you're just expecting the next higher low to go to the next higher high, to break this structure right here, to break this high. So it just skips up and down, up, down, up, down, up, down, up, down. like a ladder, if you want to think about it like that, or some stairs. It's basically when it jumps, it has to balance itself. Jump has to balance itself. If you understand how the market is constantly overbrought, then oversold, then overbrought, then oversold, then overbrought, you understand that that's how it walks itself up, basically. That makes sense.
Yeah.
So
You say
now,
overbought and oversold. That's the bank making
so
shit move.
right, because I mean, every buy and sell in the market makes the market move. The market is always constantly moving. So understanding there's always buys or sells, that means, the market was always overbought at this time. So now it has to rebalance itself. Now the buyers are selling at a higher position because they got their money. Now they're, taking their trade out. So now the market is oversold. So it just drops back down. And the people, buy it up again. So it's just, constantly doing the same thing over and over again. So this is what I'm looking for. So you got these long wicks right here, right? So this is why we use our time frames to understand that we can get a position on the smaller ones if we see a upwards momentum shift, because clearly that's an upwards momentum shift, but it's not really giving you too many entry points. And when I mean by entry points, we're looking for like, institutional candles, smart money cubes, or imbalances. So it doesn't really give you much on the 2 hours. So this is why we zoom in. Okay, 1 hour still not giving me much. 45 give me a little bit more. I'm still looking for that wick to break down, right? Because I know that wick is a candle. So we break it down to the 5 minute, and bam, we have what we're looking for. We have the institutional candle, and we have the imbalance right there. The red represents right here. The red represents the institutional candle that swept liquidity. Oops. What I mean by sweeping liquidity, I mean by taking the money. So it swept the money that was up in the top area right here. Because this is nothing but money created in the market. Touched down, took these lows out, fell into the imbalance right there to just trade higher. So once it did that, clearly played off of the imbalance. If I had a box here on this candle, that's the imbalance, played off the imbalance, traded higher, right? Broke structure. Now they created another range. They're making liquidity in the market, right? Just trading another range. So they're trading another range right now for it to break down to fill in this imbalance, because there's one huge push left an imbalance in the market. So we either looking for it to touch this institutional candle, this last down candle, last down before the up movement, because the banks sell to buy. So we either expecting it to mitigate out of the zone. What I mean by mitigate, basically to close their sell position they use to buy the market up. So what I mean by, like, if you open a trade for 8 billion lots, it'll drive the market down, and you open up another buy for, 8 billion lots, it would, drive the market up. But you got to close this sell position that you have here, which is what the banks do. You have to close that sell position. So that's where we're looking to get into the market in that candle to trade higher. And we understand that we understand where the market is going, right? We understand the market is going up to the money up here, or in this imbalance to take out this high because it's making a higher low to make a higher high, right? So it's either going to come into this imbalance or come into this institutional candle or take out this money. So this is when we just ride the wave up. So that is basically a snippet of smart money broken down on how how to, play the market basically. So we'll be risking, put our stop below the low. We can risk 15 pips. 15's not bad. 15 pips is not bad. Right? We get in. There's actually a whole level here too. This is another thing. You have the whole level of 3,900 right here where the imbalance was created. So that's another point that you can play, that price bounces off whole levels and half levels. If you know the whole level and half level theory, that's a whole nother lesson in itself. But basically price likes to bounces off. So if you just think about psychology wise, like, if you're a human, were you more likely to sell at $10.56 or $11 even? You're more likely sell at $11 even. You know what I'm saying? So it's a resistance point or or a support level basically. So when people want to get at a lower price at a whole number, okay, I'm gonna wait till it gets to this 139 whole level to buy it up. That's where I want to get into the market. So you can expect some type of reaction off of that whole level. So we're just looking for the 1 to 3 trade, which would be here. 15 pips for 45 pips, which is not bad. And even if you want to ride it up to this high, could possibly just take out that high. That's a almost a 3.5 to 1 trade, which isn't bad. So just understanding that the market just creates ranges inside of ranges. So right now is in a range inside of a bigger range. Inside of a bigger range. So it just breaks down and what I mean by that, if you use the fib from the high to the low, this can be a fib right here. I mean, this could be a range. I mean, honestly, I would probably just consider that the range. So, and it's within another range, which is the current range that it's in right now, which are these lows and these highs. I know it might look a little confusing, but I'm gonna zoom in. So basically this is the range. I'm supposed to get that high. This is the current range. So it's in a range inside of a range inside of a range basically. So let's delete some of these, a little confusing. But we're looking at for it to break out of the range, which is taking money right now. If I would consider the range that it's in now, I would say this from here to here. right? So if it breaks down, it's been creating money sideways.
Which time interval you looking at right now?
This is the 1 hour. So you're just looking at the range that it's in right now. The two red lines. I wanted to break the range, right, that is in. That created money on both sides of the market. I mean, money on this side and money on this side. So right now, they're taking the money on this, right, to fill in this imbalance, to bounce, to trade higher, to fill in that one. That's all the market does over and over again. See the upwards momentum, right? We don't trade trend lines, but if you see an upwards momentum, it's just respecting, respecting the next high. Like, I mean, the last low is respecting the last low, respecting the last low. Just basically bouncing itself up. Respected that low, respected that low, respected that low. So this is actually kind of live. I will personally be taking this trade because it looks pretty good. Got any questions? Stop below a low. You just give yourself 15 pips. Give yourself a little breathing room. Look at this area right here. Kind of stands out.
Looking at the
This little area.
range on the bottom.
You looking at what?
Hold on. I'm gonna zoom into. I'm looking at the range on the bottom. Hold on, right. My shit small.
That last push up. The last push down before the push up in this box. Right. Mitigate out of that zone. Where it broke structure had to go higher. Still keeping its structure though. This is still a higher low to make a higher high, but you can route it up to here. 70 pips. It's almost a 5-to-1 trade, which is beautiful. So this telling you that, the euros losing strength against the pound, right? But overall,
The bullish trend going on right there.
it's a bullish trend.
Bearish.
It's a bearish inside of a bullish.
Okay,
This is the overall
it's a big
trend.
bullish. It's a big bullish and it's a little bearish right there. Okay,
Right. Exactly. So the market's dropping. They could be coming in to fill the imbalances. So we're gonna get imbalances like, so you can see any imbalances in the market. Imbalances are nothing but these straight lines, because it's a buy side imbalance in the market. So it has to get some sales in this zone. It has to get some sales in that zone because it's an imbalance in the zone. That makes sense. So price has to balance back out with some sales in the zone to ultimately probably trade higher.
Because because of the bullish trend. That's why you're saying that
right? Because of
the
the bullish
overall.
trend, and you have a break of structure.
Okay, right there, being that bearish part is going on, we thinking that it's like about to bounce. It's about to bounce off and go, about to go the opposite way. It's about to go back
And
towards
go
the
right here.
bullish way.
Go here. Go to the money. It's filling the imbalance. So,
Oh,
I think I was looking for that. That never came back though. It did. It is playing off of that imbalance I had marked up. Right now, to be honest, I could be trading higher, but I mean, too many pips that is. Still 50 pips up, a minimum of 40, which isn't bad. And so move this over right quick. So if I was to like look at this trade, because this is look like a really decent trade. Long position, right? Put it where price is at. Put my stop below the low. Put my take profit up there. Make this a little smaller. So 1 to 3 trade, I would be risking 15 pips. I wouldn't go below these lows to trade higher to fill in the
I'm on
imbalance.
it, bro. Don't worry.
So that's a nice little market execution. Need some type of reaction though.
Bro.
Give me my position there. My stop is 15 pips. Right. And I want to ride it up to at least here. Well, I just do a 1 to 3, which is 45 pips. So when you market execution, that means basically that you're getting into the market exactly where price is at. So when you do that, you have to modify, your stop loss. You still have to put a stop loss, and you still have to put a take profit, but it's just putting you in the market at that exact time that you press that button. So whenever you market execution, just remember that. Um, Seeing this sell too. So the reason why I see this sell, look at this, look at the buy though. So the buy is the same thing that we talk about, right? The buy went right in the imbalance. I played the 50% of the imbalance. It created money in the market, right? It created all this money in the market from this red line till this red line, right? So I'll call that a little range, right? So then what do? They fill in the imbalance, right? This is the institutional candle, the push up, the imbalance, to fill in the imbalance. If it won't let me get it, probably. Maybe I shouldn't put it on top. There we go. That wick fills it in, hits the 50%. How do you discover 50% of the imbalance? Use your fib retracement, right? Wow. Right? This clearly that line is the 50%. I already have the horizontal array and the 50%, right? Put your stop below a low. I think I put mine below the imbalance or something. I think I just gave myself, yeah, I probably gave myself like 15 pips, right? It gave you the 3-to-1. Gave you way more than the 3-to-1. It stops all the way up there, right? So this is where we at. This is where we were. Right? I mean, that's a nice 100 pips. Would have held that, right? But now it's doing the same thing again. You can see where it broke structure here, right? This is the breaker structure.
Okay.
This is the range that is creating. So that's the bottom of the range. This is the top of the range, right? You see how price isn't moving in between. So this is a kind of a example of what you want to see on a sell. So remember we were looking at the buy, right? We're looking at the EJ buy. This is right here, right? We were looking at the EU buy, which is right there. So we understand what buys look like, right? So what about sells? So that might be gone. So if I'm looking, I forgot what chart I was looking at. Oh, yeah. So now that, so we were talking about how last time this broke structure and it gave you, it gave you your trade, whatever, right? So now, this is when you change your directional bias because this green line represents liquidity that it took, right? So I'm just going to delete that. And so that means money was sitting above here, right? Green. So money's been sitting in there since November 23rd, and it just took that money that had been sitting. Actually, it took money that was sitting over here too. So since November 20th. So that's how many days people has been participating in the market for 10 days, and all that money has been accumulated, and they just took a lot of people's money that's been accumulated in the last 10 days, if that makes sense. So after it took the money, after this wick took the money, we can go to the candle a little bit, hold on. So that candle, right, that candle right there, that last up candle is your institutional candle. Why? Because you get a large push after this push up, after this last push up. So this is identifying where the banks are, because Only they have enough money to inject that much money to the market to push it down that much. That's a lot of money. So after it took money right here, right? Actually it took money lower than that, I think. I think it took money from here too. After it took that money there, after this wick took the money there, right? It bam, put it in the range. So it created more money in the market to move it where they before they move it where they before they make their movement of where they want to go. So, you know, understanding that the banks are behind this candle, you know, what are they most likely to do? They're most likely to break this range, right? Banks always push up to push down. So they'll break this range. This is retail sellers right here, retail traders, which are trading this support line, this resistance line. I mean, this resistance line, this support line. Retail traders are trading this right now. Like, oh, yo, I'm getting paid, buzzy, buzzy. You know, but, you know, we look for the bigger trades, which we know that, you know, the bigger trades going to come from this candle to push down, to take out at least these lows that it's created. And it has a lot of money sitting right there. So I would like for it to come all the way down there, which is 125 pips for 15, which is 8 to 1. So that means you're risking $15 to gain $125. You know, that's what we'd be risking on like a trade like this. You know, because if you're just looking at where would it go next, if you just took the money from the green line, you know, where is the money going next? So this, if they just took the money from the red line, where are they going next to the green line? Where the money's sitting. So their money sitting below those lows, and it's money sitting below these bottom weekly lows that I can't even zoom out enough to show all the way down there. And you have a weekly low, this purple line. So it's a lot of money sitting down there. It's been on a downwards trend. So it just gives you more, you know, of an indicator that it could be trading lower. Because this could be the lower low that it makes. If it makes a higher high, that means it's a breaker structure probably. It's probably going to break, you know, this high or these highs right here. And that would be a breaker structure. So that would mean it's more likely to just go on the upside.
Okay.
Versus going and getting those, going to the green lines, basically. So we're just looking for the next break of the range for it to create, you know, go up and take the money sitting up here. So if it wants to come down, take the money that's sitting down here first to just take the money that's sitting up here. So that's all they do is just take money out the money, build the money up to take it. So that's what a nice little sell would look like. You know, click your buy limit. You know, if you want to pick a long or a short, it's a short because, you know, we're selling, right? Identify your targets where the market could be going, sitting lows, equal lows. Equal lows are the green line. You see that. Identify where the sweep of liquidity was. Sweep of liquidity was to the right. I mean, to the left over there. It's a red line now. If you're identifying the range that it's trading in, right? You identify the last sweep before, which is here. You can make that, you know, pink. I don't care. You know, it took these lows out, right? So looking at the range, looking at the institutional candle, which is this green, right? What is it likely to do? And that's what we want to see. That's what we want to see, because we know that they just swept the money down here, right? They just actually made it equal lows, kind of, sort of, right? swept that money, swept enough money to trade higher, to put it in the range, to break up, to take the money up on the higher side just to trade lower. So the buy before the sell. And then once they give you, a lower low, they go in for the retest just to trade lower. You can do that as well. So whichever, way you want to trade is the way you want to trade. But I was looking at this one too. Understanding that we're in the overall downtrend, we have equal lows. You had the sweep of liquidity on the upside, right? So see what the highest peak is and what did it do at the highest peak. It took money to the left side. So you put a red one there. You see you got your candle, right? So identify that candle, right? Wow, didn't do that. Identify that candle, right? Bam, that took the money. So it's still trading in the range from basically here to here. So until it breaks that range of that last low, then we can look for it to go on the upside. That's what we want to see at least. It could keep its structure, but it is making lower lows. So, I would expect for it to make a lower low and take out that green line basically. And that's how, that's what you would, well, how you want to mark up a chart, identify, the candle. All right, you got the candle. That candle right there. See, it left the imbalance. The last push left that imbalance right there. All right, you're just looking at the low. Looking at the wicks. All right. You see this wick right here, and this wick right here, it leaves this big open area. It trades into that imbalance, fills it in, and it never comes back ever. And that's right after it pushed up and just continued on down. So that would have been a great sell.
Okay.
Same thing here. Price came in, dropped down, traded into the imbalance, dropped down. Put this last candle was his last drop down. They didn't let price push up. They kept pushing price below this candle. Right? So that shows you signs of weakness. So, you could have got in for the sell. This wasn't a sure sign of a sell until it got around this area for me. And that was the breaker structure. That was the breaker structure right here. Because it created a lower low. So getting into that last candle, and it just continued to go down, and you could have rolled it all the way down here. So now we're looking for another sell, trade off of that imbalance to fill that in. I think it's a clear imbalance on the 30 or the hour. It's on the hour. You can see it clearly on the hour, the imbalance, right? So expect for it to fill that imbalance up just to trade lower.
Okay.
That makes sense.
Yeah, meaning like right now it might hit in that red, but once it do that, it's pretty much ready to go come back down.
Right, because it's balancing price out.
Okay.
because it has to balance price out. It's no, remember everything in the market is buys or sells, right?
Mm-hmm.
So that being said, this one area where there's no sales at, how do I know there's no sales there? Because it's a straight line. It's a solid straight line. It's nothing but a straight line. There's no, you see how this trades like in and out of each other? Buy sells, buy sells, buy sells, buy sells, buy sells. This just says sells and just no buys. And so they have to put buys back in this area, which
Okay.
are these candles. They have to put buys back in that area, fill in some of this area in to balance the price out to trade lower.
Now I get what you're saying. Okay.
So anytime you have like an imbalance like that after the institutional candle, then the huge down movement, that just gives you an indicator. This looks like it doesn't want to make it up there. It could be creating money in the market though, because it could be creating a range right now, which is what it looks like it's doing. Because if you look at these two highs, they're equal. So could be creating this range from this low to that high, right? To do what? To
Go back down.
go back down. Remember what they do? They just do it. The banks do the same thing on all time intervals. So whether it's 5 minute, 1 minute, they always do the consolidate, right? To push up, to push down.
Mm-hmm.
Money, money, take the money, take the money. First take money, second take money.
Okay.
So, and then you'll be sweeping these highs as well because you got equal highs over here. Oops. So all that would be a nice sweep in the money. Because those highs are equal to that high. I mean, they're not completely equal, but you know they're equal enough. You know what I'm saying? So a nice push up, to take that money and make this green because green means money, right?
Mm-hmm.
Take that money sitting above those highs to trade lower to take out the money sitting below the lows. It's sitting below all these lows. There's more money sitting down here. So that's all it does. It takes money to just take more money. Got any questions? I think that kind of sums it up.